because it's not super exciting and fancy, and I'm not like in a swimsuit on a freaking sports car with a yacht in the background, right? No, these are just numbers, and it's data, and it's examples, and it's knowledge. But it's so much money you can save if you know what you're getting. And so that's why I'm here to help you with that. PMI, the good, the bad, and the not so ugly. For more information, stay tuned for the whole video. Hi guys, thank you so much for joining me. This is your one-stop shop for anything and everything mortgage education. Be sure to subscribe to the channel because I post new videos every Tuesday and Saturday. My name is Stephanie Weeks, and I'm a 16-year loan officer. I've helped thousands and thousands of customers with millions and millions of dollars in mortgages. And today I'm here to help you with anything and everything mortgage education. PMI, MIP, what the heck does all this stuff mean? We're going to break this down in today's video, and I'm even going to break it down to numbers and specific examples. What is PMI? PMI stands for Private Mortgage Insurance, and PMI is associated with conventional loans. This is not to be confused with MIP. That's Mortgage Insurance Premium, typically associated with government loans, such as RD, VA, or FHA would be another example. Why is PMI not that bad? I'm going to tell you why. Because PMI gives customers, buyers, the opportunity to own a home when they otherwise might not be able to. So many people do not have 20 and 30% down. So put yourself in the shoes of the lender. If you were lending somebody $400,000, would you not want to take out a policy to insure yourself if they don't put enough skin in the game? Well, that's what that means. If you have a large down payment, aka skin in the game, and you're doing a 20% down, at least, conventional loan, that is the way to avoid mortgage insurance. With VA, FHA, RD, that is not the same case. And that's one thing that so many people get confused on. So many people say, oh my gosh, PMI is such a waste of money. It's so awful. It's not awful, because you know what? Then you wouldn't be able to buy the house. Would you rather buy the house and pay an insurance policy that protects the lender so that they go ahead and extend that money to you so that you can have home ownership, or save up 20 or 30%, well, at least 20, and not have that mortgage insurance? Well, honestly, a lot of times it's not going to be an option to buy if you don't have the 20%, and a lot of us just don't have that 20%. So PMI or MIP allows us that opportunity for home ownership. That's why it's not so ugly. Now, don't get me wrong. If you have 20% down and the ability to avoid mortgage insurance, abso-freaking-lutely, do it all day long. You want to save every single dollar that you can. But for most of us, we don't have 20% down payment and go conventional. So there's other options that are available that allow for home ownership. So remember, in the beginning, I talked about PMI, private mortgage insurance, that's associated with a conventional loan. MIP, more typically associated with a government loan, RD, FHA, and VA. So let's break each one down so that we can clear up so much confusion that is out there. Are you ready? Okay, conventional loans. 20% or more down payment, and you don't have PMI at all. Beautiful. Awesome. Congratulations. So fantastic for you if you can do that. Most people cannot. So then what happens? With a conventional loan, you have private mortgage insurance, which is a policy that protects the lender in case you default on the loan. PMI on a conventional loan has multiple options. Most people don't even know that. So when you think PMI, what do you think? Drop me a comment. I bet you think monthly charge, monthly fee. Yes, sometimes, right? So with conventional, you have the monthly PMI option. You have, which is self-explanatory. You have the lender paid PMI option, where you're basically paying a higher interest rate so that the lender can afford to pay the PMI for you. And there's also single premium, where the borrower, or you, which you're the borrower in this case, you're paying a one-time payment in a lump sum at closing so that you have no monthly PMI. Now, let's say that you have PMI and you're going monthly. Well then, once you have 20% equity in your home, you can request the PMI to be removed. I'm going to remind you guys, this does not apply to every single loan type. That's why I'm doing this video today, because I want you to have the right information. Conventional loan, 20% equity, you can request that the PMI be removed. Let's say that you forget. Life is busy. Life is crazy. I don't remember everything. I don't know about you, but if you forget to ask it to be removed or request it to be removed, then it will actually automatically come off when your loan has reached 78% loan to value. And that's based on when you closed, because the lender's not watching your increases and decreases in market value as your loan matures or ages. So 78% automatic fall off, 80% you can request it. We're talking conventional only, not of the loan types. Don't forget, we have single premium, monthly, and we have lender paid. Let me break those down a little bit further for you as well. So with the monthly, a lot of people don't realize, they'll say, oh, what's PMI on a $200,000 loan? I can't answer that question. Do you know why? Because on a conventional loan, this is the data that I have to enter to get a PMI quote. Loan amount, purchase price, which equals loan to value, credit score of all borrowers, how many borrowers are on the loan, and the credit score for each individual, the zip code of the property that's being financed, the occupancy, primary residence, secondary residence, investment home, units. I don't know why I can't talk today, but the units, like, is it single family, 2 unit, 3 unit, 4 unit? That all makes the difference as well as your debt to income ratio of the file, as well as if there's been any previous bankruptcies or foreclosures. Do you see why I can't just say, hey, what's PMI on a $400,000 loan? Not possible, because there's so many data points that goes into that. This is very different than FHA, VA, and RD, and we're going to talk about those next. So hang in there with me. Now, on these conventional loans and the PMI options, I wanted to go through some of the other options. I talked to you about the monthly and how that works. I talked to you about how to take it off or how to get rid of it. And I talked to you about all the data points that go into calculating the cost. Those same data points go into if you go lender paid or if you go single premium at closing. So let's dig down into that. The lender paid is where you're basically paying a higher rate for the lender to then cover the cost of the mortgage insurance for you so that you don't have that added to your monthly payment. Here's the most common question I get. If you take a higher interest rate, that interest rate does not go down when you then have 20 or 22% equity and get it removed, or you would have asked for the PMI to be removed, or it would have automatically fallen off. No, when you choose lender paid, you're paying that higher interest rate for the entire life of the loan. Let me stop you there, because many people say, that's so dumb. Is it though? Is it though? It might not be. Lending is case by case. I'm going to say that until I'm blue in the face like one of the kids on the Willy Wonka friggin' movie, okay? So this is the reason I say that. Let's say if you went conventional, let's say if you were looking at lender paid, and let's say if you plan to live in the home for 4 years. Why do you care if it's there, if you're paying a higher interest rate for 30 years, if it saved you enough money monthly and over the 4 years that it made sense to go that route? So I'm an advocate for whatever works for you, your budget, your numbers, and is the best deal. Sometimes that's lender paid, sometimes it's monthly, and sometimes it's single. Now let's jump into single. What single is a one-time payment, drastically reduced, paid at closing in a lump sum so that you have no monthly. And that has its, what's the word I'm looking for? That has its moments as well. I'm going to give you 2 quick examples. One customer where the monthly actually made the most sense because of how quickly that they plan to accelerate or reduce the balance of the loan, that if they paid the single, it would have cost them more, where typically the single would cost you almost half as much as the monthly if you went that route, And it's going to be more of a long-term loan, meaning that you're not going to pay it off super, super quick. And so you want to take those things into consideration when you're looking at monthly, lender paid, or single, is how long you're going to be in the house, but also how long you're going to have the loan and how quickly you're going to pay the loan down, because those things might make a difference in your decision. So now you know everything you need to know about conventional PMI. I know you're so excited. I know it's goofy. I know it's nerdy, but it's information that you need to have. So now let's go ahead and jump into some other loan types. So with FHA, that's what we're going to talk about right now. With FHA, the minimum down payment is 3.5% typically. Whether you're putting down 3.5% or whether you're putting down 50%, FHA has MIP, upfront, and monthly. And you did hear that right. Conventional doesn't have upfront and monthly. It's either or. FHA has upfront and monthly. So, and remember, just like I said, conventional loan, 20% down, no PMI to worry about. FHA, even if you put 20% down, you have MIP. And remember, on conventional, you can request the PMI to be removed at a certain point. With FHA, the guidelines have changed several times over the last 16 years that I've been doing this. At the moment, you're going to pay MIP on an FHA loan for the life of the loan unless you meet certain criteria. One of those being at least putting 10% down, but you still have it, but you might not have it for the whole life of the loan. So there's some different circumstances there that'll kind of put you case by case. So with FHA, you've got the upfront, you've got the monthly. You don't have the option for lender paid. You do not have the option for single premium. You have upfront and monthly. Got it? Good. Okay, now we're going to talk about RD. RD is another government-backed loan that's a great opportunity, just as FHA and just as conventional. With RD, you're going to have MIP upfront and you're going to have it monthly. You're going to have it for the life of the loan. It's a little different than FHA because FHA's MIP is stagnant on the monthly payment, like it's going to remain the same. With RD, you have the upfront, you have the monthly, but the monthly declines each year based on your balance and how much you paid down the loan. So it's a great opportunity, of course, again, to get you into a home when you don't have 20% down, but you don't have the single premium payment option. You don't have the lender paid option. You have the upfront and you have the monthly. And that's how RD works. Now moving on to VA. VA is based on eligibility. So you may have an upfront MIP to pay. The percentage is not stagnant, it's based on eligibility, and some veterans are even exempt from that upfront funding fee, which is a form of MIP. There is no monthly MIP on VA loans, no matter what. So conventional, you have upfront, monthly, or single. Single, lender paid, or monthly. FHA, you have upfront and monthly. RD, upfront and monthly. VA, upfront, depending upon your eligibility, could be zero, and you have no monthly. That's exciting, right? Yes. Thank you for your service. You deserve whatever breaks you can get for your sacrifices. Thank you, thank you. I don't know about you, but I like hard numbers. Hard numbers. So that's what we're gonna do. I'm gonna compare for you some of the different options. I'm gonna go FHA, RD, and conventional. I'm not gonna really give you much information on VA just because it's so case specific. So I'll give you a little tidbit on VA real quick, and then we're gonna jump into the other programs and how that looks with using actual numbers. With VA, if you're funding fee exempt, you have no upfront, and of course you already know by watching this video that you have no monthly. Sometimes with VA, you might have a 0.5% upfront calculation. That'll kind of make more sense when I go through some of these other numbers with you, but you're gonna have the 0.5% upfront calculation, and sometimes it's over 3% that you're charged for that funding fee or MIP for the VA loan. And that is rolled into the loan unless you decide to pay cash. That's not money you have to come up with in cash unless you choose to. So that's VA. They've got the sliding scale based on eligibility. So make sure you talk with your loan officer if you've got further questions about the VA funding fee or MIP. Let's move on to, let's go FHA first. And I'm gonna have to keep looking at my notes because I promised you specific numbers. So I've gotten all that written down. FHA, you have your upfront mortgage insurance, and that's going to be 1.75% of your loan amount. And I'm going to use a $305,000 loan in this example. So we got $305,000 times 1.75%. That means you're going to pay a funding fee upfront of $5,337.50. $5,337.50. So that's going to be your upfront. That's going to be funded into the loan unless you decide to pay cash. The cents are not funded into the loan, so the 50 cents you would come up with, hopefully you can handle that, the 50 cents, and then $5,337 would be financed into the loan using the calculation of the 1.75% upfront funding fee. And so that's your cost of the upfront. You still have the monthly as well. Let's see what that looks like. We're using a $305,000 loan example. The monthly calculation for the MIP is a 0.85% calculation. So keep in mind, on conventional, remember I talked to you about all the data points that went in to calculate the monthly or any PMI actually on conventional. Remember, it was like a crazy amount. It was like credit score, loan amount, how many borrowers, loan to value, loan type, occupancy type, loan term. Actually, I forgot to say that earlier. Loan term actually affects it as well. Is it a purchase? Is it a rate and term refi? Is it a cash out refi? Forgot to mention that earlier in the video, so I apologize. I'm gonna throw those in there now. But all those different things, so many data points go into what is your monthly, in this example, PMI calculation on conventional. With FHA, it's very simple. It's a 0.85% calculation. What the heck does that mean? Let's dive in. A $305,000 loan amount at a 0.85% calculation, then I'm gonna take 0.85% times $305,000, and then I'm gonna divide that by 12. That means that my monthly MIP on this example for an FHA loan is $216.04. $16.04 in that example. That's the standard calculation with some very small exceptions, like like the reason for the loan, purchase versus rate and term refi versus cash out versus the term 15-year versus 30 versus the LTV. Is it 70%, 90%, like all those things. But they're few and far between. For the most part, you're really going to expect a 0.85% calculation on that. So this is a good example. Moving on to RD. Are you still with me? I know you have to be excited about all these numbers. So moving on to RD, we have a 1% upfront and a 0.35% calculation. I'm going to remind you again that with conventional, you had upfront or monthly or lender paid, right? And if you put down 20%, you didn't have it at all. Well, with RD, you still have upfront and monthly, regardless of any down payment that you choose to make. It is a zero down payment loan, but just so you know that if you did put a little bit of money down, you're still paying the upfront and you're still paying the monthly. So you've got that. So let's dive into the numbers. Remember, we're using a 700 credit score, irrelevant for RD calculations. Same if you had a 640 or an 800. But we're comparing case-by-case examples here. Your upfront is 1%. Remember, FHA was 1.75%. So now your upfront is 1%. 1%, we're gonna calculate that, 305,000 times 1%. Do you have your calculator? Are you doing it with me? $3,050. That also, just like RD, just like FHA, can be rolled into the loan or paid for in cash. We're going to compare, in case you weren't making your notes, I want to remind you that the 1.75 on FHA was over $5,000. The 1% on RD is $3,050. So now let's compare the monthly. The monthly is at a 0.35% calculation, whereas if FHA, remember, was 0.85. So a 0.35% calculation. So we're going to do our calculations. 305,000, 0.35% calculation, divided by 12. We have $88.96. That's $88.96 per month, compared to FHA was $216.04. And extra bonus, remember, FHA is remaining per month, same, stagnant, consistent, whatever word you like me to use today. And RD is going to be declining based on the balance and reviewed every year. So that's going to compare FHA to RD. And next, we're going to talk about conventional. Okay, don't forget, so many data points on conventional that RD, FHA, and VA don't have that they care about when we're calculating the mortgage insurance. I'm going to forget some, I'm sure, because it's so many, but loan amount, loan term, loan type, credit score, debt to income, how many borrowers, zip code of the home, property type, single family, 2-unit, condo, 3-unit, 4-unit. I think I forgot to say condo earlier. All those different things go into the calculation. For this example, I'm using a 700 credit score. Now we know why it counts, right? Why I've said that on the other examples. 700 credit score, primary residence, single family home, going with a purchase, not a cash out refi, not a rate and term refi, but just a purchase. I'm going with a self-employed borrower, no prior bankruptcies or foreclosures. Let's see, checking my notes here. Non-refundable, because you actually have that option to explore as well. 30-year term. And I think that's it. So remember, you have the upfront, you have the lender paid, and you have the monthly. In this example, I'm just going to give you the comparison of monthly. With this particular example, there's no upfront, so that's going to save you over $5,000 compared to FHA, over $3,000 compared to RD, because you have no upfront in this example. Your monthly is going to be a 0.62% calculation. RD was 0.35, FHA was 0.85, so many numbers. And for this, it priced out at 0.62. So remember, our loan amount is $305,000. The monthly PMI in this calculation is $157.58, compared to $88.96 for RD, compared to $216.04 for FHA. You've got that. Now, don't forget, monthly, lender paid, single premium, all those. This one's just the monthly example. And just to let you know, the monthly example here that I use 0.62%, just this week, I have priced all these different types of loans, right? And some are at 0.2, 0.32, all the way up to some examples priced at over 1%. Remember, FHA was 0.85, and that was $216 a month. And some of these actually got priced at over 1% based on the specific data that went into the pricing of this PMI on the conventional example. So I know this is a ton of information. I hope it's not super boring. I'm always worried to bore people when it comes to all the mortgage education, I say, because it's not super exciting and fancy, and I'm not like in a swimsuit on a freaking sports car with a yacht in the background, right? No, these are just numbers, and it's data, and it's examples, and it's knowledge. But it's so much money you can save if you know what you're getting. And so that's why I'm here to help you with that. Since I always try to provide extra value, I have a download for you, of course, and that's going to be, it's just called PMI Mortgage Insurance. And it just kind of gives you a little bit of information, things that we've even talked about today in the video, but just so you have more of a reference point and some actual notes and something tangible to grab onto, So hope you enjoy. I'm going to tease you for a minute. In the comments, if I said so more than 15 times, say yes. I have got to work on saying so. At least I don't say but every 2 minutes or well, it's a work in progress, right? What can I say? But in the comments, shoot me a yes if you did hear me say so a lot, because I'm just being funny today. And otherwise, put peace in the comments if this stuff is really helping you and if it's making some sense. Not that you need to calculate and have all these numbers on your own deal. You don't. That's what the fantastic loan officers out there are for. But what you need to know is that there's differences and there's pros and cons to each, depending upon your situation. Not your neighbors, not your friends, not your uncles, you. Please subscribe to the channel, hit the bell to be notified for when I post new videos. Really appreciate your feedback, appreciate your comments. I'm gonna pop up some other videos here and here and here and here for you guys to check out. And let's connect on social media as well. _ The Real Stephanie Weeks is my Insta, and the website stephanieweeks.com. Have a fabulous day.